Good evening, everyone. So, Saturday evening, and we are going to continue with our previous topic, which was capital structure. Okay. So, in the last session, we discussed a good number of concepts about capital structure, in which we have seen how do we select uh, the plan based on EPS criteria. And of course, if we have the information of market price per share and there is P ratio, then we also use the P ratio to calculate the market price, and then we choose the plan which is providing us with the highest level of uh, market price per share. Okay. Now, in today's session, we will be taking the discussion forward for something called as capital structure theories. Okay, so we'll be discussing about capital structure theories in today's session. And this capital structure theory is all about certain Nobel Prize winning concepts or theories that were discovered or that were basically propounded in the history with regards to capital structure. So let's try to understand what are we really talking of when we say capital structure theories as such. Okay. So let's try to understand what is this capital structure theory. Okay, so let's understand what's the capital structure theory initially. So when we talk about capital structure theory, it is all about certain theories or concepts that are debated. So there are certain points of debate that we are going to look at. Now, what is the debate or what is the question that we are essentially discussing about? Let's have a look. The question that is being discussed or understood over here is about whether capital structure, which is the debt equity mix, is going to affect the value of the business. Okay, one thing that I just want to announce you students. I have uploaded the previous class notes, but then it has gone into some other batch because there was some update in the portal. So I just got a mail regarding that, and I'll be doing it to your batch, which I think it is the September 26th batch. So to your batch, I will be loading the notes by today or by tomorrow morning. Okay, so all the chapters notes together along with this capital structure, I'll be uploading. Okay. Now, let's go for capital structure theory. So first thing that we are going to discuss or the point of debate in capital structure over here is, the question is, will capital structure that is the debt equity mix, will capital structure, essentially the debt equity mix, is going to affect the value of business. So will capital structure, that is a debt equity mix, is going to affect the value of the business. So to make it more more elaborate, the question that we are looking for is, will taking debt, so will taking debt for investment, taking debt for investment in business affect its value? So will taking debt for investment in business affect the value of the business? That is what the question is. So the question is, if you're going to take debt for the investment in business, is it going to affect its value? So essentially, is value really relevant for the business or not? Right? Or to make it other way around, let's say there are two companies. One is company X and company Y. There are two companies. They are same in all respect. Both the companies are same in all respect except debt equity. Except the debt equity mix. So company X and company Y is same in all respect except the debt equity mix. So basically you can say this company is having no debt and this company is having debt. Now the question is, will value remain same? Will the value of both companies remain same? So for company X, where you have no debt, and where there is company Y, there is a debt, is the value going to remain same or is the value going to be different? Is the value of both companies going to be same or is the value going to be different? So the answer could be, there are certain financial experts who say yes, that the value is going to be remaining same, or they answer it in a different way. They say, this simply means, is debt relevant for value of companies? Is debt relevant for values of the companies? The answer is yes as well as no. If you say that the debt is relevant, of course, then it means you're saying the value is not going to remain same. If you say that the value is going to change, if you say that the value of the company is not at all relevant or it's not going to be affected by debt, then you say yes, the value will remain same. So if you say value is same, it means debt is playing no role. If you say value is different, it means debt is playing some role in determining the value. So based on that, we have something called as theories of relevance. We have certain theories called as theories of relevance. And we have certain theories which are called as theories of irrelevance. So we have something called as theories of relevance and theories of irrelevance. So there are certain theories which we are going to say which are relevant and certain theories which we are going to say irrelevant. Okay, so we are having certain theories as theories of relevance and certain theories as theories of irrelevance. Now, why do we say that there are certain theories of relevance and irrelevance? Relevance means what? Value is going to affect it. Value of value of the companies will differ. This simply means value will differ if capital structure is different. And theories of irrelevance will say value will not differ or value will remain same. Value will be same if capital structure is different. So theories of relevance will say value of the company will differ if capital structure is different. And theories of irrelevance says that value will be same if capital structure is different. So there are certain theories of relevance which say that yes, the value of company is going to change. Okay, and there are certain theories which say that the value of company is not going to change. So which are those theories? So first, the theory that we have is net income approach. We have the net income approach. Second method that we have under the theories of relevance is said to be traditional theory. And one more we have over here. But before that, let me write down the theories of irrelevance. Theories of irrelevance are net operating income approach, and secondly, Modigliani Miller approach. So net operating income approach, Modigliani Miller approach. Okay. Or we also call it as Modigliani Miller arbitrage approach. Modigliani Miller arbitrage approach. The third theory is going to be again an extension of this. Okay, which is turning out to be like, theories of irrelevance. This is same approach with the taxes. And of course, this is without taxes. So when there are no taxes in the economy, then this arbitrage approach works. And if there are taxes, then this is going to be the scenario. Okay, did we get it? Everyone? Yes? Okay, now let us go for each one of them theories. But before we go to the theory, we need to be sure about certain assumptions, because if assumptions are not held, then these theories actually won't make any sense for us. So we would definitely like to look at certain assumptions which are going to be the basis of this entire discussion. So what are the assumptions that we are following over here? Assumptions in most of these theories. First up, only two types of funds. So there are only two types of funds, which are debt and equity. So there are only two types of funds, debt and equity. There is no other fund. So we are essentially discarding the the preference dividend concept. Okay, so we are completely discarding the preference dividend concept from here. What I have written in the second point? Without taxes. This is representing without taxes scenario. Okay. So there are two types of funds. The first assumption that we have is only debt and equity. There is no other type of fund which is applicable. Essentially, we are talking of there is no preference share capital or any other type of funds. The third assumption that the second assumption that is applicable in some cases, it is no taxes. And of course, when we remove the assumption of taxes, then what happens is what is seen in this third up model. The third assumption is 100% dividend payout. So there's going to be 100% dividend payout. Okay. So you're not going to retain anything. So if you're not going to retain anything, of course, the growth is not going to be there. Fourth assumption is the firm has perpetual life. So perpetual life is the assumption that we have. Fifth assumption is business risk is constant. Business risk is same throughout. So the company is going to face the same amount of business risk. Okay. Perpetual life. Actually, perpetual life means the company is going to exist forever. There are no plans for winding up of the company in near term. Perpetual life, or you can say going concern assumption. Okay. Then sixth assumption and the last is pattern of financing is constant. So whatever way you are financing, that is remaining constant. So pattern of financing is constant. So whatever is your financing pattern, basically debt or equity, you can say if you're only equity, you're going to remain equity for your throughout the life. If you are having certain amount of debt, that same amount of debt is going to be there till perpetuity. So it means we are talking of only the irredeemable debt. Okay. So these are certain assumptions based on which the entire set of capital structure theories are going to be based. Okay. The entire set of our theories is going to be based on this capital structure. Okay. Now, before we go to the understanding the theories, we need to look at certain formula for that. Okay. We need to look at certain formula for that. Now, what sort of formula are we really looking at? Because here, see, we are talking about only the value, right? So value of firm. So if you're really talking about the value of the firm, what do we essentially mean by the term value of the firm? How do you determine that value of the firm? So that is what we need to first be clear about. So let us say we want to calculate value of equity. Value of equity. Will these assumptions change? No, these assumptions are going to be same throughout. Okay, these assumptions are going to be same, except if you're saying that some assumption is going to be violated. Otherwise, the assumptions are more or less, it's going to be in the same situation every time. Okay. So how do we determine the value of equity? Remember, value of asset is simply going to be present value of all future benefits. One page up. Okay, I want to take a screenshot. Done, Achal? Yeah. Okay. Value of equity. So when we say value of equity, or for that case, value of any asset, that's going to be present value of all future benefits. So value of asset is present value of all future benefits. So when you say that present value of all future benefits is the value of asset, what will you say value of equity? What is the benefit that the equity shareholders get? What is the benefit that the equity shareholders get from investing in a company? What is the benefit? Yeah. What is the benefit that you get as an equity shareholder? Dividend and price appreciation. Okay. But remember, we said that the company is not going to pay, but company is not going to have any retention, or I can say there's going to be 100% dividend payout. So everything you're going to get as dividend, right? And if the company is not going to pay any, if the company is not going to retain anything, of course, there's not going to be any growth. There's not going to be any growth in the profit. Okay. So how do we get this value of equity then? Obviously, the present value of all future benefits. So value of equity is simply going to be present value of all future profit after tax. So value of equity is simply going to be present value of all future profit after tax. Okay. So all your PATs are going to remain same because 100% dividend payout, no new form of capital funding. So the profit is going to remain constant. So profit for the first year, the present value of profit for the first year will be PAT upon 1 plus K. K is the cost of equity because we are going to discount all the profits at cost of equity, right? We're going to discount all our profits at a cost of equity. So PAT upon 1 plus K plus PAT upon 1 plus K square plus PAT upon 1 plus K cube. This is for the third year. And this is going to continue till perpetuity. Okay. So for equity, we can determine future PAT, but how can we determine future benefit of assets? Future benefit of any asset for that case. If you have a building, you're going to get the rentals. If you have a vehicle, then the money that you will save on your transportation and the value that you assign to your convenience. So the valuation is something, it is a subjective thing. So as of now, for the equity, the benefits that you're going to get is dividend or the PAT. Okay, so PAT upon 1 plus K plus secondary, it's going to be PAT upon 1 plus K square plus PAT upon 1 plus K cube, and then it just goes on till perpetuity. Okay, so value of equity is going to be the total of all of that. Now, PAT upon 1 plus K plus PAT upon 1 plus K square plus PAT upon 1 plus K cube, it goes on till perpetuity. Now, when we look at this thing, does it seem like some mathematical series? Does it seem like some mathematical series for to you? Geometric progression, right? So geometric progression with the first term being pat upon 1 plus k. And what is the common multiple that we have? Common multiple is 1 upon 1 plus k, right? So we simply take this as summation till infinity is a upon 1 minus r. So a is pat upon 1 plus k, the whole divided by 1 minus 1 upon 1 plus k. So this is pat divided by 1 plus k, the whole divided by 1 plus k minus 1 upon 1 plus k. So we have 1 plus k getting cancelled, and ultimately value of equity is pat upon k. Value of equity is pat upon k. Got it? So formula for value of equity is whatever profit you are going to get divided by k. Okay. And we can say in absence of tax, value of equity will be profit before tax upon k. So if there is no tax, then you can say value of equity is simply PBT upon k. Same way, what can you say about the value of debt? What can be the value of debt in this in this way? If your value of equity is pat upon k, what can you say about value of debt? What can you say about value of debt? Yes. What's the value of debt? Well, value of debt will be interest upon KD. Value of debt will be interest upon KD, because for equity shareholders, it is PBT or PAT, which is income. But for debenture holders, it's interest. Okay, similar lines. Can you tell me what will be the formula for value of the firm or value of the entire business? What can you say about the value of the entire business? Value of firm or value of entire business? Any idea? Yeah, definitely it's going to be value of equity plus value of debt, because entire business will be the sum total of all equity and debt. So value of firm will be value of equity plus value of debt. Right? Okay. There is another formula for value of firm, which is EBIT upon KO. KO is overall cost of capital. So value of firm is EBIT upon KO. Okay. So value of firm, value of equity plus value of debt. Value of firm over here, it is EBIT upon KO. EBIT upon KO? Well, if you look at value of firm, it is, we're talking of the present value of all future benefits that the company is going to give. So what is the present value? What is the benefit that the company is going to give to its investors? It is EBIT, right? EBIT is the income which the company gives for all its investors. So therefore, we say it is EBIT upon KO. This is like interest for debenture holders upon cost of discounting. This is income for the equity shareholders upon the cost of equity. So this is your benefit or income for all the investors divided by the overall cost of capital. Okay, fine. So these are the four formulae that we need to be keeping in mind. Now let us go for the capital structure theory one by one. So first thing that we are going to discuss is called as a net income approach. So we are looking at net income approach. So in this net income approach, the first point which they say is that cost of debt should be less than cost of equity. Is it correct? What do you feel? Cost of debt less than cost of equity. Is it correct? Yes, of course, yes. Why? Why do we say that the cost of debt is lower? Cost of debt is definitely lower because the risk that the debenture holders are taking or risk that bankers are taking is comparatively lower as compared to the equity shares. So of course, the cost of debt is definitely going to be less than cost of equity. Then, before we go to what they are saying for the second thing, let me just give you an example. You do the calculations, and then we will talk about what's the conclusion about. So let's say initially a company is having 10,000 as its equity capital. So 0 is the debt. So what will be weight of equity and what will be weight of debt? What will be the value of weightage of equity and weightage of debt? If a company is having only equity in its capital, what will be the weightage of equity? 1. And of course, weightage of debt is 0. Right? So let's say cost of equity and cost of debt is given to us. Cost of equity is 15% and cost of debt is 10%. So how do we calculate the overall cost of capital then? The overall cost of capital KO. How are we going to calculate the overall cost of capital, which is KO? Overall cost of capital will be weight of equity into cost of equity plus weight of debt into cost of debt. Okay. Overall cost of capital will be the weight of equity into. So this is like 1 into 15% plus 0 into 10%, which is 15%. Okay, so equity, let us say, after that, what the company says is, let us withdraw 1,000 of our equity funds and make it as 9,000 and instead replace it by debt. So withdraw 1,000 and replace that money with debt. So now what will be the new weightage of equity? What will be the new weightage of equity? How come KD be 10%? KD can be anything, right? Of course, the KD weightage is 0, so that's not considered in our calculation. So this is now what? 0.9 and 0.1. So with this same 15% and 10% thing, we can calculate the KO. Okay, so let us say in next situation, it says 7,000, 3,000. Then you have 5,000 in both cases. Then you have 1,000 and 9,000. So can you do all these calculations now? And especially we want the impact on KO. So can you do these calculations, like calculation of the weights and the overall cost of capital? Yes. Okay, so go ahead with the calculation and tell me what is happening to the overall cost of capital when you are increasing the debt. Just calculate the overall cost of capital first, please. Okay, so what's the weightage? Weightage is 0.7, 0.3, 0.5, 0.5, 0.9, or this is 0.1 and 0.9. And overall cost of capital is what? 15%. It reduces to 14.5%. Further, it reduces to 13.5%. Further, 12.5, and last you have 10.5. So can we say as weightage of debt increases, KO decreases? Yes, everyone? As the weightage of debt increases, overall cost of capital is decreasing. As weightage of debt increases, KO decreases, right guys? Yep. Okay. Fine. So we say as the weightage of debt increases, the KO decreases. Now the third and the concluding point which they are saying is, as KO reduces, they say value of firm increases. Okay, let's try to illustrate this with example again. We have the EBIT and we have the KO. What do you think? If the debt and equity proportions are changing, is your EBIT going to change? Is your EBIT going to change with the change in the debt and equity proportion? No, because it's just the capital structure which is changing. Your business remains the same. The business will provide you the same level of EBIT anyways. So as the KO reduces, the value of the firm increases. So we can say EBIT is anyways going to remain same. Let's say 2000, irrespective of whatever is your capital structure. But of course, at a different capital structure, we have the overall cost of capital which is changing. Initially, it was 15%, then it became 14.5%, then it became 13.5, then 12.5, and then 10.5. So KO becomes 15%, 14.5%, 13.5%, 12.5%, and 10.5%. Now we know value of the firm formula. Value of the firm is EBIT upon KO. Value of the firm is EBIT upon KO. So what is the value of the firm? EBIT upon KO. We can calculate it. Calculate the value of the firm, guys, everyone. And see what's happening to the value of the firm. Just check what's happening to the value of the firm. What's happening with the value of the firm? If EBIT changes, then KO will obviously change. No, KO is not changing, right? So your KO is falling just because of change in the capital structure. So what's the value of the firm? So here it is 13,333, 13,793, 14,814, 16,000, and 19,047. So can we say as weightage of debt increases, KO reduces, value of the firm increases. So what should be the conclusion? Is the value of the firm getting affected by the debt equity ratio, or it's getting affected by your capital structure? Is the value of the firm getting affected by the capital structure? Yes or no? Is the value of the firm getting affected by the capital structure? Yes, everyone? Yes, perfectly. True. Absolutely correct. Value of debt, as the value of debt increases, KO reduces and the value of the firm increases. So as the KO reduces, value of the firm is going to increase. Okay. Okay. So that is your net income approach. And then after that, we'll go for the next approach, which is uh, Now, let us go for the next theory, which is net operating income. Okay, when the net operating income approach was, was just being thought over, investors or the financial experts were essentially looking at uh, what is the case with the net income approach, which can be criticized, or they're looking for identifying some shortcoming in the net income approach. Now, what is a shortcoming in the net income approach? Can anyone identify any shortcoming in the net income approach? Can you think about something, which is a problematic or which is incorrect, whatever the net income approach is saying? What can you say about the problem, or some shortcoming, something is missing in this net income approach? Can you identify that? Because if you identify that, that's going to be the base for net operating income approach. EBIT is considered constant. No, that's not a problem. So that's an assumption, in fact. Tax reduction, well, that is an assumption. So we're not considering that aspect. What second point? I didn't get what you're saying, Achal. What are you talking about the second point? Dividend distribution. That is an assumption that whatever PAT you have, that will be fully distributed as dividends. As weightage of debt increases, KD decreases. Weightage of debt increases. How is KD going to decrease? KD is constant. Well, the shortcoming or the problem, it lies in this cost of equity. Now just think, as the weightage of debt is increasing, do you think equity shareholders are going to face the same amount of risk? Or is the risk for equity shareholders going to increase? If the debt is going to increase, what about the cost of equity? Are the equity shareholders going to expect the same rate of return, or they will be asking for a higher rate of return? Yeah, they will face different risk. And as the risk changes, as the risk is going to change, what's going to happen to the uh, equity shareholders return? Of course, they will expect a higher rate of return. And that brings in the next model to discuss, which is net operating income approach. Okay, so what is this net operating income approach? First point which they say is cost of debt is less than cost of equity. Is it a valid point? Cost of debt is less than cost of equity. Is it a valid point? Definitely yes. Anytime your cost of debt is going to be less than cost of equity. But what they say is, as weightage of debt increases, definitely KO will decrease. So as we have seen in the previous example, KO is going to decrease, but there is going to be a side effect of this. So as the weightage of debt increases, initially we can say, okay, KO will decrease. KO will be pushed down. But one side effect emerges out of it. What is that side effect? The risk of equity shareholders increases. And as the risk of equity shareholder increases, what will happen to KE, cost of equity? What will happen to the cost of equity? Will it remain constant or is it going to change? KE will increase. And see, KE is one of the component of KO. So if KE is increasing, what is going to happen with KO? Can I say KO will increase? So now, on one side, there is a downward pressure due to lower cost of debt. And on the other side, there is an upward pressure due to increasing K, due to increasing return or increasing returns required by the equity shareholders. So what is going to be the net effect of these two? What is going to be the net effect of these two? Net effect which they say is that KO will remain constant. KO will remain constant. Got it, everyone? KO is going to remain constant. So KO will decrease on one side and KO will increase on one side. So since there is a dual pressure on that, the KO is going to remain constant. KO will become a stagnant number. Okay. So now how is it happening? Let's take an example to understand it. Let us say equity, debt. I'm sure you can calculate the weight of debt and weight of equity. I'll give you the value of KE, KD, and I'm sure you can also calculate the KO value as weight of equity into cost of equity plus weight of debt into cost of debt. So equity is, let's say, 9,000, debt is 1,000, equity is 7,000, and debt is 3,000. Then you have equity as 5,000, debt as 5,000, equity 1,000, and debt is 9,000. Weight of equity is 0.9. Of course, this is 0.1. K is over here. It is 15%, 10%. Let's say this is 16.43% and 10% because now your weightage is what? 0.7, 0.3. Over here, weightage is 0.5, 0.5. And here this is 0.1 and 0.9. Okay. So 19%, 10%, and let's say for a very high level, you have 55% and 10%. What are you saying, Anil? Sir, equity should be paid only if profitable. See, equity shareholders, KE is their expected or their required return. It all depends on the risk that you're undertaking. So whether they will be paid or not paid, that's a secondary question. But if the question is what is the return that the equity shareholders are going to ask for, that's your key, right? K is not what the actual return which equity shareholders are going to get. K is the return that they need or return that they require. Okay. So just calculate the KO in this case, everyone. Yes, expected cost, correct. Calculate the K in all the four scenarios in the given question, guys. Just check what is the overall cost of capital. Yeah, how much it is? 14.5%. Right. So 14.5% is the KO value, irrespective of whatever amount of debt or equity you are asking for. So this model says that your cost of equity will increase in such a way that your overall cost of capital is remaining same. Or overall cost of capital remains same as 14.5%. So of course, now tell me, if the overall cost of capital is remaining same, what can you say about the value of firm? Value of firm will remain constant if KO is constant, right? So we can say KO is going to remain constant. Yeah. Any problem or shortcoming in this model, do you feel? Anything which you find, something not correct? KD? What are you saying about KD? Daksh, can you elaborate? What are you saying about KD? Daksh is saying that something wrong with KD. What's wrong with KD? To the extent increase in KD. KD is remaining same, 10% in this case. Okay, Daksh is saying cost of debt is considered constant over here. If it changes, then the cost of capital may increase. Okay, fine. That's absolutely true. But then, you know what? Here you're assuming that whatever amount of loan you take, the banker is going to charge you the same rate of interest. Is it really going to be that case that if you borrow 50 rupees or if you borrow 50 crores, is the bank going to charge you the same rate of interest? Is the bank going to charge you the same rate of interest? No. And therefore, we have the next model called as traditional model. Okay. So what is this traditional model say? Traditional model says that the amount of borrowing which the company undertake, it is going to be in phases. Okay, it's going to be in phases. Now, what are these phases? So there is going to be something called as a phase 1, phase 2, and then the phase 3. So the model says that in the first phase, your amount of debt and equity, or the cost of debt and equity, is going to remain same. So your K is on top, KD is lower than that. And of course, the resulting impact is that KO is going to reduce. Because it says that for small amount of debt, now over here on x-axis, we are representing the weightage of debt. So the model says like if the company borrows some small amount, 100 crore company, if it borrows few lakhs, it's not going to alter the expectation of equity shareholders, because it is simply said if your cost of equity is going to change, if weightage of debt, we say as the weightage of debt changes, K, we say that they say that initially for small amount of small percentage of debt, your overall cost of capital is not going to get affected. It's going to remain same. Overall cost of capital is going to remain same. Sorry, not overall cost of capital. Your KE and KD is going to remain same, because if it's a 100 crore company and if it borrows, let's say 5 lakh, 10 lakh, or maybe for that 50 lakh also, equity shareholders will be still in that chill mode, because they'll say it's okay, company will borrow for short-term requirement. That's the day-to-day activity. So they'll not be getting affected by that to that extent. But if a particular limit is crossed, if a particular level is crossed, then the cost of equity is going to increase, or equity shareholders are going to ask for a higher rate of return. And there, your KD is still remaining constant. Like, let's say, if the company has borrowed out of total capital 10%, the equity shareholders are like, okay. If it is going beyond 10%, debenture holders or bankers will be fine, but equity shareholders will start seeking more return because they're taking more risks. So, can you tell me what's going to happen to the KO in the first phase? What is going to happen to it in the second phase? The KO was reducing, right, in the first phase, because the K and KD will remaining constant. Now, when your K is rising, can I say KO will become constant? Or, to be simply, I can say, so this is a phase 1, which is like your net income approach. Which is like your net income approach. Can you tell me what is this second phase like? Second phase is like net operating income approach. Right? So over here, equity shareholders are asking for a higher rate of return, whereas the overall cost of capital remains constant and cost of debt is also constant. But beyond a particular level now, beyond a particular point, debenture holders or bankers are not going to be satisfied with that original lower rate. So like initial, like let's say 100 crore company, and if it has borrowed, let's say 50 crores or more than that, 60 crores, 70 crore, 80 crore, then what will be the expectation of debenture holders? I mean, what do you think the banker will charge you the same rate of interest? Yeah. Yeah. No, of course, the cost of debt is going to increase. And as the cost of debt increases, what do you think? What's going to happen with the overall cost of capital? Yeah. So KO is also going to increase. So obviously, this is somewhat more polished approach as compared to net income and net operating, because you're saying that it's not always a case that you know the overall cost of capital will always keep on increasing or it keep on decreasing. It all depends on which phase you are. If you are in the first phase, your KO is going to decline. If you're in the second phase, your KO is constant, and if you enter the third phase, your KO is going to increase. And as KO increases, value of the firm is going to fall. Okay, fine. Okay, so that's your traditional model, everyone. Traditional model. And I think we are done with the three models as of now, which is the net income approach, net operating income approach, traditional theory, and then these three models are done. We are yet to do these two models, which is Modigliani-Miller arbitrage and Modigliani-Miller approach with the taxes. So we'll be doing both of them and certain questions based on these concepts also after we meet after the break. Okay, let's take a break. Post break, we will continue with this concepts and also certain questions. Okay. Are you all there, guys? Yep. Okay. So we're done with the traditional model. Now let us go for uh, the next thing, which is uh, Modigliani-Miller with the taxes approach. Now, Modigliani-Miller with the taxes approach. Let's have a look at it. There is some issue. Okay. It's Modigliani Miller with the taxes model. We'll first have a look, and then we will look at the next aspect, which is arbitrage thing. So let us look at Modigliani-Miller with taxes. So the discussion starts with net operating income approach. So under net operating income approach, we say that value of levered will be same as value of unlevered. Okay, right? Okay, so NOI approach, we said value of levered will be equal to value of unlevered form. Value of levered form will be equal to value of unlevered form. But this was applicable when there is no tax. So this was applicable when there was no tax. Now, when tax comes into existence, when tax comes into existence, the system changes a bit. Okay. So what is the change that is happening? When you have tax, which is the firm that's going to have, which is the firm which is going to have savings, or which is the company, VUL is value of unlevered. Value of levered and unlevered. It means levered means a company with debt. So it's a company with debt, and value of unlevered is company without debt. Okay, company with debt and company without debt. Okay, so normally when we say value of levered and value of unlevered is equal, which is a company with debt and a company without debt is going to be same. Right? Now, the question is, in case of levered and unlevered, which company is going to pay less tax? Can you tell me which company is going to pay less tax? Yeah, of course, company with debt. So this company is going to pay less tax, right? And this company is going to pay more tax, right? So if you're going to pay less tax, if a levered company is going to pay less tax, can I say cash flow for investor will be higher in case of levered form, and cash flow for investor will be lower in case of unlevered form? Correct, guys? Right? For example, let us say we start with EBI. So a levered and unlevered. Okay. Levered company is paying, let's say, 2,000 interest. Here they are not paying any interest. Levered is the company with debt. Levered is a company with debt, and unlevered is company without debt. So you get a PBT as 8,000 and 10,000. Then we further subtract tax, which is, let's say, at the rate of 30%. So 2,400 and 3,000. And then you have the profit after tax. So 8,000 minus 2,400 tax. That is going to be 8,000 minus 2,400, which is what, 5,600, and this is 7,000, right? So what will be the total payment to investors? What will be the total payment to investors in case of levered? What is the total payment that you're going to make to the investors? Can I say to the debt investor, you're going to give 2,000, and to the equity investor, you're going to give 5,600, right? So total payment is what? 7,600. What about the money or the payment that you're going to make in case of unlevered? It is only 7,000. So if it is a levered firm, it is able to give 7,600 as payment to the investor, but unlevered it is 7,000. So what is the extra cash flow to investors of levered firm? What is the extra cash flow? Can I say it is 5,600 minus 5,000, which is 600. So the extra cash flow which we have to the investors of levered firm is 5,600. Sorry, my bad. 7,600 minus 7,000, which is 600. right? Vedant, this 7,600 is total of these two. We are not looking at only payment to equity investors. We are asking for payment to all investors. Okay. So 600 is the extra cash flow that we have to the investors of the levered firm. Okay. So now tell me, for this situation, it's not 600, then 5,600 and 7,000. How come 5,600? It is 7,600, right? We are paying how much to the investors? To the investor. When you say investor includes equity and debt, both. Equity and debt, both. Right? So we are saying interest is being paid to the debenture holder, and this is being paid to the equity holder. The total payment is 7,600. So we are paying extra cash flow to considering all our investors in totality. We are having extra cash flow to the investors to the tune of 600 rupees. Okay. So which company should be having a higher valuation? Is it the since the cash flows for their investors are different, of course their values are not going to be same. So what will be the relative valuation? What will the relative valuation? Exactly. Value with debt, or the levered company have higher value, right? So how much higher? So Morgan and Miller says value of levered firm will be value of unlevered plus something extra. Value of levered firm will be equal to value of unlevered plus something extra. Now, what is that something extra that we are going to have here? So value of levered firm will be value of unlevered plus something extra, that will be the value of debt into tax rate. Okay. So value of levered is going to value of unlevered plus the amount of debt into tax rate. Okay. So value of levered firm will be equal to value of unlevered plus the extra value is debt into tax rate. Now, of course, this debt into tax rate is arrived by taking the present value of tax saving. So this is representing present value of all future tax savings. Okay. So this is your model, which we say as the model with taxes. This is the model with taxes. That's your model with the taxes, everyone. Okay. So model with the taxes, it was placed, as you can say, in theories of relevance. Theory of relevance means value is going to differ if cash flow is different. Okay. So for example, let me just take a example for this understanding. So we have, let's say, a levered firm and unlevered firm. Okay. So we have a levered firm and unlevered firm. Both of them are, let's say, having a EBIT of 1,20,000. So both firms are having a same EBIT of 1,20,000. We have the cost of equity of unlevered as 12%. Cost of equity of levered is not. Value of debt over here, it is 5 lakh, and there is no debt, of course, in the unlevered. So value of debt is 5 lakh, value of unlevered is something, which is not applicable. So EBIT 1,20,000 in both cases. Cost of equity is 12%. Debt is 5 lakh. Unlevered, you say there is no debt. And rate of interest. Rate of interest in case of unlevered, it is 8%. And of course, over here also it is not applicable. Tax rate is 25% for both companies. Okay, so tax rate is 25% for both the companies. Now the question is, we have to identify what is the value of firm. Okay, so to calculate value of both the firms, in fact, I can say you have to get the value of equity for both and value of firm for both. Will you try it? Can you try it out, guys? KE in case of lever, that is what you have to calculate. In case of lever, KE is not given. KE is not given in case of levers. You have to calculate that. Try it out, guys. Okay, shall we? Okay, let me just try it out for you. So we start with EBIT. In both cases, it is 1,20,000. We need to subtract interest. How much interest are we going to subtract? How much will be the interest? 5 lakh into 8%, which is 40,000. So we have PBT as 80,000. And then we pay taxes on this. Of course, over here you don't have any interest payment. So less tax at the rate of 25%, which is 20,000 in first case and 30,000 in the second case. So you get a PAT of 60 and 90,000. So PAT is 60,000 and 90,000. Then let us talk of value of equity. Value of equity is what? PAT upon KE. PAT upon KE. So this is 60,000 divided by KE. We don't know. Okay, so let us just leave it as it is. We'll do it later. But I can get the value of equity here as 90,000 divided by KE over here is 12%. So what's the value of equity? 90,000 divided by 12% for unlevered. $90,000 divided by 12%, that's 7,50,000. Okay. Value of debt is 0. So value of firm for levered, can I say it will be same as value of equity? So value of firm for the levered will be same as value of equity, which is 7,50,000. Correct, guys? Got it? Value of firm for the levered entity cannot be calculated as of now, but value of firm for the unlevered, we can get it for 7,50,000. Okay. Now, what about the value of firm for levered entity? What will be the value of firm for the levered entity? Can I take it as same as the unlevered firm? Can I take that value of unlevered firm is same as the value of levered firm? Yes or no? No. Then we know value of levered firm. The formula for this is what? Value of unlevered plus value of debt into tax. So we will say 7,50,000 plus the value of debt. Value of debt is what? 5 lakh. 5 lakh into tax rate. So what is the tax rate? So 7,50,000 plus 5 lakh into, which is a debt, into tax rate is 25%. So what's the value of firm? What is the value of the firm? How much is this? Five lakh into 0.25, which is 1,25,000 plus 7,50,000, which is 8,75,000. Okay. So 7,50,000 plus 5 lakh into 0.25, which works out to be 8,75,000. So we got the value of the levered firm. Now, can you tell me what will be the value of equity? Value of equity. Hence, value of equity will be what? Value of firm minus the value of debt. So that's 8,75,000 minus the value of debt is what? 5 lakh. So what will be the value of equity? What will be the value of equity? 8,75,000 minus 5 lakhs. So value of equity is 3,75,000. Right? Calculate the value of debt. Value of debt is given already, 5 lakh. What do you want to calculate it? Debt value is given, right? 5 lakh. Vedant, where do you want to calculate the value of debt? The amount of debt is given, 5 lakh. So that is what we are going to subtract and arrive at the value of equity, which is 3,75,000. Now, once you have done this value of equity as 3,75,000, can you calculate the cost of equity now? Formula for cost of equity is what? PAT upon value of equity. Because since we see that value of equity is PAT upon KE, so KE will be PAT upon value of equity. Okay. So value of equity will be 3,75,000. So I can say KE is PAT, which is 60,000 upon 3,75,000. So KE is what? 16%. Did you get it, everyone? Is this question clear to you? Yep. Yes. So can you solve another question on the similar lines? So I give you another question. Will you be able to solve it? Yes. Okay. Fine. So let me just give you this question now. I'm just giving the question over here. So you have levered and unlevered. Or I'll just do it a bit different. Okay. Value of firm. Unlevered firm value is 60 lakhs. And the levered firm value is something we have to compute. Overall cost of capital, or wait, not overall cost of capital. We'll give it in the same format as the previous question. See, levered and unlevered. I'm giving you the EBIT as 30,000. Debt is 70,000. Here there is no debt. Interest rate is 10%. In the next case, this is not applicable. So EBIT, debt, interest rate, tax is 25% in each case. And let's say KE is not known, but here the KE is, let's say, 15%. I want you to calculate the value of equity and also value of the firm. Okay, so value of equity and also value of the firm. Try solving this. Try solving this. Okay. Did we all get these numbers? 17.69. Yes. Value of equity 97,500. Value of firm 167,500. And K is the primarily one, which is 17.69. Got it, everyone? Okay, fine. So with that, we are stopping here for the day. Next session is definitely due for leverage, but I will use that session around 1 hour for discussing the concept of capital structure. And also we have the revision session also on these topics. Okay. We have tomorrow, but we'll be doing that revision thing. It's not the leverage wala thing. Okay, leverage is on Tuesday. Okay. If you want to take a screenshot, Achal, take a screenshot. Okay. Is there any remaining lecture for it? Yes, we will have. Okay. Bye bye. Tomorrow is a revision session. Okay. From beginning to end, we'll be uploading this portal on portal. Achal, don't worry. The same PDF will be there on our portal. I'll do it. Okay. So with that, let us just stop here. See you in the next class. Bye bye, guys.